Hello kids, welcome back to our YouTube channel. I'm Ms. Aruni. I will be covering your grade 10 business and accounting studies. Today we will be discussing about our lesson number 4, the introduction to accounting. So accounting is one main part of your paper. Your paper will consist of two parts, the business studies as well as the accounting. So you have to give your attention to both the sides with it because 50% of your paper will consist of the business studies while the rest of the 50% will be on accounting. So today I will be teaching you the basics of accounting. These are the learning outcomes which you should understand. You should be able to describe what is accounting, show the aims and importances of accounting, explain the business transactions and present examples, as well as identify the business transactions related to assets, liabilities, income, expenses, and equity. So, what is accounting? The basic definition states that accounting is a process of providing financial information required by the interested parties of a business for their decision making. So, what is accounting? It is a process. Accounting is a process of what? Providing financial information to whom? All the interested parties of the business, which will help them for their decision making. So accounting is a process which gives financial information to interested parties of a business for decision making. So if I underline the key points, accounting will be a process. What does it do? It provides financial information to whom? The interested parties of a business for what? For their decision making. So accounting that mainly provides financial information is called as financial accounting, while those accounting aspect that provides accounting information for decision making, if it is for decision making, that is management accounting. Right? So there are two aspects which you will not be discussing in your level, that states that accounting consists of both financial accounting as well as management accounting. But in your level, just understand that accounting will be a process providing financial information to interested parties to help them in their decision making. Then what might be the objectives of accounting? By doing accounting, we will be able to know whether the business has earned a profit, a sufficient or an adequate amount of profit, whether financial position of the business is sound, that is whether we are in a good financial position to fulfill the legal requirements. For example, our accounts as registered businesses, we need to present them to respected authorities, either for tax collection or we have to send our annual reports to the business registration organization. So with whatever the organization, whether it's the Chamber of Commerce under which we are registered or whether it might be another authority, we should be able to send our annual details to them. So that is why we call it as a legal requirement. And then also to minimize disadvantages of omissions and commission of transactions, we always have to organize our financial activity. So in a nutshell, to know whether we are having sufficient profit, whether we have a sound financial position to fulfill the legal requirements and to stop omissions and to organize financial activities, we will be performing accounting. Now we will be discussing about the business transactions. So before I discussed about the definition and the objectives of the business, so these are what the business aims. Now we are talking about the business transactions. So accordingly, a transaction can be identified as an exchange of resources between the business and other parties, right? So when there's an exchange of resources between a business and another party, we call it as a business transaction. Among those transactions, the transactions of which their value can be measured in terms of money are considered in accounting. So Pute, we always consider transactions which we can measure. If we can measure the transaction, then it is coming under our accounts, or we are going to record it in our accounting books. So some events that are occurred in the businesses are also considered in accounting if it has a monetary value. For example, if there's a sales of goods of rupees 100,000, so you can measure the amount of goods sold, there's a money value, then it is coming under our accounts as it is a business transaction. If we paid salary of rupees 50,000, then it is a business transaction. There's a value recorded. So we can take it as a transaction. So let's move to the elements of accounting. So if there's a question asking, write the elements or list down the elements of accounting. These are the 5 elements. You have assets, liabilities, equity, income, and expenses. Assets, liabilities, equity, income, and expenses. So these are the 5 elements of accounting. So now I will be discussing each element for you to understand. So I will be presenting a definition as well as the characteristics. This is an important part. All these definitions and mainly the characteristics should be memorized by you. You should be able to list out all these characteristics of each element without, like, don't construct your own sentences here. Try always to stick to the characteristics either you which you have read in this video or which is directly given in your textbook, right? Because that is something that is definitely coming for your exams. So what are really assets? Assets are the resources that are generated as a result of past transaction, right? If there are resources which are generated, or resources means the benefits that are generated, then we call them assets. So an asset is a resource controlled by the business as a result of past transaction and from which future economic benefits are expected to flow to the business. So this is the definition you have to remember. Assets are resources controlled by the business, which is a result of the past transaction, and due to which future economic benefits are expected to flow to the business. So assets are controlled in the business as a result of past transaction, and due to which future economic benefits can be coming into the business, right? So that is what assets are about. Now, for example, we can divide assets into two. Those assets that are less than 1 year, 3 months, or assets that are kept in our business for 2 or 3, 6 or less than 1 year, we call them as current assets. For example, this goods which we have bought for sale, right? Or else maybe a bundle of stationery, right? Those that are in a bookshop, the stationery in a bookshop, we can take it as an asset, right? That way, those are the current assets. Then mainly the main current asset is cash, as well as what are the non-current assets or the assets that are taking more than 1 year? The land and building of the business, the machineries, the motor vehicles, all those that has a lifespan more than 1 year will be considered as non-current assets. Now let's go towards the characteristics of assets. So assets have 3 basic characteristics. First one is it has arisen as a result of a past transaction and it is controlled by the business and there's an inflow of future economic benefits, right? So there's an inflow of future economic benefits. The economic benefits words, those two words are missing here. Please write that there's an inflow of future economic benefits. Then I hope you understand what are assets. Here the definition is given and the characteristics are given. So if there's a question asking define assets, please write a clear definition, and if you can provide examples as well. As well as if there's a question asking characteristics of an asset, it's better to write a one line or a two line definition and then list out the characteristics. So as long as you write a perfect answer matching the time given, right? Don't go on writing essays. Always realize the time given is limited. You have limited time to cover all the questions. So because of that, plan your answer so that you can write a good answer. And then liabilities. So our next element is liabilities. Those are the payables of a business that had arose as a result of past transaction that could be simply considered as liabilities. So if there is a payable, that is something that we have to pay as the business, if the business is obliged to pay another person or entity a sum of amount as a result of a past transaction, that will be called as a liability. So there are current obligations which will result an outflow of assets. So if we, as I said, assets, cash is an asset. Similar way to pay, we will use our cash in the business. So when we pay from our cash, the cash will go out. So that is why we call it as an outflow of assets, right? So liabilities also can be divided into two. They are current liabilities and non-current liabilities. So those that have a lifespan of less than 1 year. Imagine a bank overdraft. That is a good example for a current liability. And imagine we took a bank loan for 5 years. We took 5 million for 5 to 10 years. A payback period of 5 or to 10 years is there for a 5 million loan. Then put there, its lifespan is more than 1 year. Because of that, it is considered as a non-current liability. Now let's look at the characteristics of these liabilities. So they arose as a result of past transaction. There's an outflow of economic resources when settlement is based, right? Or when the settlement is made, we will have an outflow of economic resources. And also you can write, it is also having the ability to affect our resources or affect our assets, which will make an outflow. And then let's go to the equity. Equity is the value of assets that belong to the owners of the business. So whatever the money, machinery or anything brought by the owner to the business is falling under the equity. I hope you can remember on our first lesson, the lesson number 1, where we talked about the basic concepts. I told you about capital, the contributions from the owner. So this is all the equity. In your level, you are using equity and capital synonymously, right? But there's a difference which you will learn in your future grades. So equity is the owner's contribution to the business. All the resources or the assets brought by him is equity. After the settlement of liabilities, after the settlement of such liabilities, the assets that remain belong to the owner is equity, right? So in a business, all the money that is brought by the owner, and after the business transactions, if there's a remaining amount, it will be also a part of the equity. So the remainder is the profit. Profit is a part of equity. You do not need to worry about it now. In the future slides, I will be teaching that clearly, right? So in a single owner's business, we call his contribution as capital, but when there are more owners, we call that as equity contribution. So what are the characteristics of equity? The value remaining after assets settled by liabilities is the equity, and it creates contributor right to claim assets. So equity, the owner has the right to claim assets for the money he has given. So that right is given to the owner. So I hope you got an idea what assets, liabilities and equity are. Now we are going towards the rest of the elements, the last two, income and expenses. So what is income? Income can be defined as an increase in equity. So I hope you realized. Now, formally we discussed about these assets, liabilities, and equity. Assets do not have an issue or a relationship with liabilities and equity, and no, none of them are related. But when it comes to income and expenses, Putte, this income falls or is a part of equity. It has the ability to put an impact on equity. It can increase the equity except if it is owner's contribution. ඕනගේ contribution එකක් නැතුව equity එකේ වර්ධනයක් සිදු වෙනවා නම් අන්න එතකොට අපි මේ element එක නැත්නම් ඒ transaction එක අපි classify කරන්නේ income යටතේ. Right? If there's an increase in equity without the contribution of the owner, then we will be classifying that transaction under the element of income. Right? So what are the characteristics? It is an increase in equity, but it is not given by the owner as capital. Right? So the sales, the rent received are all a part of income. And then the expenses. So the expenses can be defined as a reduction in equity. This also has an impact to equity, right? If there's a reduction in the equity, except if it is the owner's behavior. If the owner is drawing money, we do not say that that is an expense. ඕන කෙනෙක් යාට සල්ලි අරගන්න එක අපිට වියදමක් වෙන්නේ නැහැ පුතේ. ඒක එයා බිස්නස් එකට දාපු මුදලින් කොටසක් අරගන්නේ. එතකොට අපිට ඒක equity එකෙන් deduct කරනවා මිසක් ඒක expense යටතේ classify කරන්න බෑ. If the owner is taking a sum of money out of the business, you cannot classify it under expense. It is not an expense. That time you have to deduct it from the equity saying that it is a drawing. So except that instance, except a drawing, or except the owner taking money away from the business, all the other expenses, maybe it is rent, maybe it is paying salaries or wages, maybe it's an insurance expense, maybe buying refreshment, whatever the expense incurred will be reducing the equity other than the owner taking away what he has put to the business, right? So the characteristics are reducing equity and not occasions where owner do drawings. So I hope you understood what are these basic elements about. Now I'm discussing how income and expenses have a relationship to the equity. So if we look at the behavior of income and expenses, when we deduct expenses from the income, you know the remaining amount is either the profit or the loss. If the income is more than the expenses, you will have a profit. If the expenses are more than the income, you will have a loss, right? So always this profit is a part of the equity. So you can realize that equity equals all the additions of the income and the deductions from the expenses. But there's something you have to note, that is additional capital also increase the capital or the equity, but it is not an income. Nor owners taking money from the business for their own use. That means a drawing is not an expense, right? So additional capital or additional money put is not an income, nor owner's drawings will be an expense. Other than those additional capital and drawings, anything that increase the equity will fall under income, and anything that has the ability to reduce equity will fall under expenses. So I hope you got a clear idea or the basic idea of what these elements and their relationships are about. So how can you identify the elements of accounting? If a business transaction is given to you, Putte, follow this order. I won't be asking you to stick to the same, but just go through it so that you can get an idea, right? Before teaching you this part, let me tell you something that you have to remember. Always remember the owner and the business are two separate entities. That is, business is something different from the owner. Owner is only a part of the business, right? The personal matters of the business does not come in the personal matters of the owners, we do not take that into account, or we do not take that into consideration for our business, right? So now if there's a transaction, first think, is it an owner's contribution, right? Is the owner giving that amount? If it is yes, it will be going to the equity. But is it something that the owner is taking money, right? Then if that transaction is about owner taking money, you should directly reduce that amount from equity. But if it is a result of a past transaction and the business assets or the benefits are increasing, if the resources are increasing, Pute, that falls under assets. And if it is a result of past transaction and it will result us to pay for it, either we pay from cash or the goods because we are obliged to pay, then it is a liability, right? So I hope you understood. If the owner has something to do with this transaction, it falls under equity. If the owner is giving us money to the business, so it will increase the equity. If the owner is taking money from the business, it will reduce equity. But if it is a result of a past transaction, that is, it does not meet the first two, then you have to come down. Then if it is a result of a past transaction and it improves the business, or it gives it increment in the business resources, it becomes an asset. Or if it is a current obligation or we have to pay back to that person, then it falls under liability, right? So other than that, if these transaction has an effect on the equity, if the equity is increased but not because of the owner's contribution, yeah, they go for income. And also if it is reducing equity and that is not due to the owner taking money, it will be an expense. So I hope you understood how you have to decide whether they are equity, assets, liabilities, income, or expenses. So, what element of accounting the business transaction fit for? It is you who have to decide, right? You have to understand the characteristics of them and then analytically go step by step and realize the proper element it belongs to. So, I have a small exercise here. I have taken the three main elements, those are assets, liabilities, and equity, to teach you this exercise, right? So the first answer is given, that is electricity expense. The expense is also given, so I won't be uh, doing that again. It is an expense, that is why I have divided this into income and expenses. So then it will be an expense which will reduce the equity. If it is an investment, there will be a cash inflow, right? So here it is not an investment from the owner, so then it will be an asset. If it is commissions received, that will be an income. It will be here. If it is sales, what happens? It will be a income. It falls here. Putta, I'm not doing the double entry. I'm just helping you to understand which element it belongs to, right? Double entry part will be covered in our next lesson. So don't think, oh, she missed the double entry. I did not miss it. I'm just teaching you the basics, right? So if it is an advertising expense, it will be falling under expenses. A bank loan. So bank loans will be a non-current liability, it will fall here. Capital contributed, it should be falling under equity. I will be keeping it here in the middle. The creditors, right? You can put it as current liabilities. The commissions paid, you are paying it so that it becomes an expense. The vehicles of the business, it is an asset. The repair expenses of the vehicles will be an expense. Investment interest income, it's an income, so it is coming here. The debtors of the business are a current asset, and the interest paid on the bank loan, Though we wrote bank loan here as an uncurrent liability, the interest paid is an expense. So I hope you got an idea of what all these are. But all these are described briefly in your textbooks. These videos are done to give you a summary, right? And this is not about the double entry, right? It will be covered in future. Here I will be teaching you the basics of the accounting elements. So, I hope you got a basic idea of what this lesson is about. Here we are just introducing you to the accounts. We are talking about the basic elements and how one side of it or how the main elements are affected, right? We are discussing the double entries in our next video. So, till that, hope you enjoyed learning with us. Thank you.